Welcome back. Today we'll be discussing what are stocks. This video is concerned with letting you know precisely what stocks are, what sort of stocks there are, the way they trade, discovering the right stockbroker, and the nuts and bolts of executing your particular exchanges. For someone who's chosen to begin investing, this stuff might seem daunting, but wouldn't you want to be a business owner while never appearing at work? Suppose you might sit back, watch your group develop, and just relax as the cash comes in. This scenario may seem far-fetched for you, however it is closer than you think and probably easier to get there than you might have imagined. As you may have been wondering, I am discussing the owning of stocks. This awesome class of money-related instruments is definitely one of the most amazing devices ever designed for building real wealth. Stocks are anyhow a part and frequently the base of almost any investment portfolio. When you start the journey to financial comfort, you need to have a clear comprehension of stocks and how they trade. In the course of the last several years, the normal individual's premium in the stock exchange has developed substantially. What was before a rich man's toy has now transformed into the weapon of choice for generating wealth. This interest, coupled with developments in changing engineering, has opened up the market so that these days practically any individual can possess stocks. Subsequently, we are discovering a far more extensive reach of folks utilizing stocks as money-making vehicles. This has both been an exceptional and a terrible thing. Regardless of their heightened presence, in any case, most folks don't completely grasp stocks. Much is studied from casual exchanges with associates and relatives who really have no idea what they're comparing notes regarding. Chances are you've caught these folks say things like, "Steve's brother raked in huge profits in business X and now he's got another hot tip." Or, "Watch out with stocks, you can break your bank in a day." So much of this falsehood is dependent upon a get-rich-quick mentality, which was in particular, it was pervasive through the astonishing dot-com showdown in the late 90s. Individuals imagined that stocks were the answer to easy money with no danger. The resulting dot-com slam in reality demonstrated this. Stocks can and frequently do make enormous profits, but they are far from riskless. The sole answer to this predicament is merely training. The key to securing yourself in stocks is to comprehend where you're putting your cash and to do it with order inside the skeleton of your arrangement, inside the structure and the scaffolding of your strategy. It is these goals and the goals of these lessons to deliver the foundation you need to settle on investment choices yourself. I'll begin by clarifying what a stock is and the diverse sorts of stocks. Then I'll explain how they are exchanged, how you purchase stocks, how to discover a broker who's ideal for you, and like I said, the precise nuts and bolts of pursuing monetary information and considerably more. Quite simply, a stock is a stake in the possession of a business. The stock stands for a portion of the association's possessions and profit. As you get more stock, your possession or ownership share in the group gets greater. Holding an association's stock indicates that you are one of the numerous holders or shareholders of an association, and you have a portion, but usually a relatively little portion to the whole lot to the association that they claim. Yet, this indicates that, in fact, you claim a modest bit of each bit of furniture, each patent, each trademark, and each contract of that association. As a holder, you are entitled to your share of the association's wages and additionally any voting rights appended to the stock. A stock is signified by a stock certificate. This is a special bit of paper that is evidence of your proprietorship or ownership. In our current digital age, you won't ever truly get to see this archive on the grounds that your brokerage agent keeps these records electronically, which is otherwise called keeping imparts in street name. This is finished to make the allotments more effortless to exchange. In the past, when an individual needed to sell their stock, that individual took the physical printed authentications down to the brokerage firm's brick-and-mortar location. Now, bartering with a click of the mouse or a telephone call makes trading much simpler for many individuals like you and I. However, I must admit I do miss the extravagant engraved stock endorsements. They look like $100 bills with very intricate designs and watermarks and such. Being a shareholder of an open association doesn't mean you have a say in the regular running of the business. In other words, one vote for every portion to choose the governing body at yearly gatherings is probably the degree and the extent to which you have a say in how the association is run. And also, being a shareholder of Apple doesn't mean you get to stroll into the Apple store and get a free iPod whenever you please. The administration of that association is expected to expand the worth of the business for the shareholders. If this doesn't happen, the shareholders do have a right. They can vote to have the administration evacuated and a new administration put in place. Truly, regular investors like you and I probably don't own enough shares to have a significant material impact on this association. Unfortunately, it is the veteran investors and the billionaire heavy hitters who make these choices. For the typical shareholder, not having the ability to supervise the business they've invested in isn't really that big of a deal. It's not even really a bad thing. The value in being a shareholder is that you are qualified for a segment of the group's profits and have a portion of its shares. Benefits are now and again paid out in the form of yields. The more shares you possess, the greater the segment of the benefits you get. The portions are only pertinent if the business goes bankrupt. If there should arise an occurrence of liquidation, you'll split up whatever's left over after every last one of the banks have been paid. This final focus is worth reiterating. The imperativeness of stock holding is your share of ownership and profit. Without this, the stock wouldn't be worth the paper it's printed on. Another aspect of stock is its constrained obligation, which indicates that as a holder of the stock, you yourself are not actually liable if the group is not fit to pay its duties. Different associations, for example, partnerships, are situated up for the purpose that if the partnership goes bankrupt, the loan bosses can come after the associates or shareholders independently and auction their houses, their automobiles, their furniture, and so forth. Owning stock indicates that no matter what, the worst case scenario is you lose your backing, in other words, whatever money you've put in. Regardless of the possibility that an association you do own shares of goes bankrupt, you can never lose your private possessions. So why might an association issue stock? Why might the organizer split up the benefits with the individuals instead of hoarding all the profits for themselves? This is due to the philosophy that at some level each association should raise cash. To do this, groups can either obtain it from some individual, a venture capitalist for instance, or raise it by selling parts of the group, which is regarded as issuing stock. An association can acquire by taking advances from banks or by issuing bonds. Both of these systems fit under the umbrella of deferred payment financing. Moreover, issuing stock is called value financing. Issuing stock is favorable for the group being as how it doesn't need the association to pay back the cash or make premium installments along the way. All the shareholders get, as a reasonable exchange for their cash, is the trust and hope that the stock could sometime be worth more than what they paid for. The foremost bargain of a stock which is issued by the private group itself is called the Introductory Popular Offering, the IPO. It is imperative that you grasp the difference between an association financing with indebtedness and financing with value. At the time you purchase a duty speculation, for example, the security, you are ensuring that the profit of your cash, that is, the vital, on top of promised premium installments. This isn't the case with value venture. By ending up being a manager, you take on the risk that the business will never be successful and never make any money at all. Exactly as a small business owner isn't insured a dividend. As a holder, your share on holdings is less than that of the loan bosses. This indicates that if a group goes bankrupt and sells, you, as a shareholder, don't get any cash until the banks and bondholders have been paid out. We call this total necessity. Shareholders will make good money if an association is profitable. However, they likewise stand to lose their whole financing if the association ends up spiraling down the drain. It must be noted that there are no absolutes concerning specific stocks. Certain groups pay out portioned profits, but many other businesses don't. Furthermore, there's no commitment to pay out profits at all for those firms that have customarily given them. Without yields, a speculator can profit on a stock just by way of its upswing in the market. If the stock is increasing in worth, a shareholder can sell the stock outright and neatly tuck away the favorable difference between what they bought it for and what they sold it for. On the downside, any stock may go bankrupt, in which case your venture is worth nothing and will be close to impossible to sell. Obviously, and understandably, this all sounds completely negative. Don't worry too much because there is indeed a bright side. Undertaking heightened risk demands heightened profit for your investment. This is one of the biggest reasons why stocks have truly bested different investment types. For example, securities or reserve fund accounts. Investments or ventures in stocks have consistently had a steady benefit of around 10 to 12%. Those are favorable numbers. The two most abundantly bought and sold stocks are these: common stocks, and preferred stocks. Common stocks are common, surprising. When most folks elaborate on the subject of stocks, they're generally pointing to this sort. Indeed, the larger piece of the pie of all stock issued is of this common type. The stock I was describing roughly a minute ago was this kind of stock as well. Common stocks represent ownership in an association, and like I said, just as we discussed, a portion of these business benefits, which could possibly be paid as yields, most likely will be paid as yields. Investors get one vote for each stock to choose the board members who do regulate the major choices made by that administration. Over the typical lifespan of a business, common stock, by method of capital development, yields higher dividends than just about any other speculation. This higher return is also reflective of the heightened risk that the common stocks hold. In the event that a group goes bankrupt and exchanges, the normal shareholders will receive no cash until the lenders, bondholders, and preferred shareholders are paid first. Preferred stocks stand for some level of ownership in an association. However, this generally doesn't accompany the same voting rights. This can differ from business to business. With preferred stocks, investors are ordinarily guaranteed a settled payment until the end of time. This is not quite the same as a common stock, which have variable yields and are never guaranteed. The primary factor that sets these two types apart can be witnessed in the occasion of liquidation. Preferred stock shareholders are paid after the shareholder, and still after loan holders. Preferred stock might in addition be callable, indicating that a group has the alternative to buy the stock from the shareholders whenever and for whatever reason, usually for a premium, however. Some folks understand preferred stock to be more like a duty than value. An interesting thing to consider about the types of stocks we've just discussed is to see them being some other region nestled between bonds and normal allotments. Common and preferred are the two principal manifestations of stock. On the other hand, it's also likely that associations will specifically revamp distinctive classes of stock for any avenue they need. This structure is typically unique to each business. They're not the same, it's not consistent, it's not a blanket. The most normal explanation behind this is the association needing the voting power to stay within a certain governing structure, and because of this, certain different classes of shares are given distinctive voting rights. Case in point, one class of shares might be kept and reserved for a select group, say the board members, who are given 10 votes each for each share of stock, while other, less controlling stocks might be issued to the greater part of investors, the masses if you will, and are given 1 vote per share. In scenarios where there is more than one class of stock, the classes are customarily designed and designated as Class A and Class B. Ginsburg-McElroy has 2 classes of stock. These differently structured stocks are signified by placing a corresponding letter after the business's abbreviation or acronym, quote-unquote, GMEA and GMEB, or GME.A and GME.B. This stands for Ginsburg-McElroy A, Ginsburg-McElroy B, and like I said, corresponding letters for each type of controlling stock. Most stocks are traded on exchanges, which are spots where buyers and sellers meet and settle on a cost. Certain exchanges are physical areas where transactions are done on a trading floor. You've undoubtedly seen pictures of a trading floor in which traders are fiercely hurtling their arms up, waving, yelling, motioning to one another. That hectic, chaotic stock market environment, that's a trading floor. The other sort of exchange, and this is something that we've seen more of, is the virtual exchange, made out of an arrangement of workstations, screens, computers, where exchanges are made electronically. As you're probably aware, our digital age is hurtling forward, and with concern to trading, the advancing can be felt immensely. Don't quote me, but I wouldn't be surprised if in the next 10 years, trading floors, the physical ones, were completely obsolete, completely antiquated, and all trading was indeed electronic. Because of this rapid advancement, folks like you and I have just as much access to control and to trade as the representatives who are physically on the floors of the exchanges. More access and more control means more profit capability. I'm sure you like the sound of that. I know I do.